What's up, everybody? It's Austin. I'm building a $1 million portfolio here publicly on YouTube and sharing every step of the way. Today, I'm telling you about 5 of the best growth stocks, and there are 5 companies that I actually own in my portfolio. As always, we lead with transparency here. This is my money. These aren't recommendations. And we're putting $3,000 into this portfolio every month and building it from $10,000 to $1 million over the next 10 years. This isn't some get rich quick thing or buy a stock and it explodes overnight or anything. None of that stuff is a sustainable way for real people to invest, and that's not how I want to invest. So if you like this style, if you like what I'm talking about, I'll really appreciate it if you like the video and subscribe to the channel. Here's a portfolio, $23,879. We've put $25,000 total in, so we're down about $1,000 and down 7%. The portfolio was opened February 15th, 2022. We're building this thing over 10 years and putting money into it every month. I hope stocks go down over the short term because I don't need this money. It gives me a chance to buy more amazing companies and get more shares over the next 10 years, that's what I want. So it feels great when our stocks go up, but we should be hoping that they go down if we're invested for the long term and don't need the money over the next 5 years at least. That's how I invest. I'll do a full portfolio update and go through all the companies and why I own what I own at the end of the week. So just, again, make sure you're subscribed if you're into that type of thing. The top companies I own in the growth bucket, we've got GitLab, Tesla, which is a new one. Made a video about that. Check it out in the in my previous videos below. Amazon, CrowdStrike, Snowflake, Monday, Twilio, and Mercado Libre. The 5 best growth companies we're talking about today are CrowdStrike, Snowflake, Monday, Datadog, and Bill.com. So, Austin, what makes those the 5 best companies? They're not even your largest positions. So what are you even talking about? Oh, well, Austin, I'll tell you what I'm talking about. The metric that we're talking about in this case that I think separates the top-notch growth in software as a service companies from the rest is a rule of 40 metric, which takes last 12 months revenue growth plus, in this case, last 12-month free cash flow margin, adds them together. When the cash flow growth plus free cash flow margin is above 40, that means they are in the realm above the rule of 40 metric. Why is that important? Only a small share of software as a service companies can sustain growth rates 30 to 40%. In a McKinsey study, out of 100 public SaaS companies that they studied with revenues above 100 million in May of 2021, median revenue growth rate was just 22%. Then if we go down, so that's the growth side of the business. We also want to know the profitability or cash generating side of the business, which is where the free cash flow margin comes in. That tells us, can this company produce cash and free cash flow aside from just that completely unprofitable revenue growth? So what does that picture potentially look like in the future? That's why we want the ability to generate free cash flow. And right here we see that the 100 companies they analyzed had a median last 12 months free cash flow of just 10%. So if we look at the 22% is the median revenue, and the median free cash flow as a percentage of revenue, which is the free cash flow margin, is 10%. That's 32%. That is below the rule of 40. And why is that important? Why does that tell us the best companies from the rest? Well, McKinsey's research finds that barely 1/3 of software companies can achieve the rule of 40. Additionally, from their studies in 2011 to 2021, they found that businesses exceeded the rule of 40 performance only 16% of the time. So we're not just looking for companies that can do it once or 1 year. We're looking for companies that can sustain it and do it long term. That's the truly exceptional companies. What is this? This is a table with a ton of crazy looking data. Let me explain it to you, Austin. What is it? This is from Clouded Judgment, which is a Substack from Jam & Ball. I'll share Jammin's Twitter profile and Twitter link in the description below so you can get access to it. He shares a lot of great stuff. He's a venture capitalist investor and shares a lot of great stuff on cloud companies and SaaS companies. He's put this table together and he shares it out for free. But what we're looking at here is we've got the 5 companies underlined on the left side in red: Snowflake, Datadog, Bill.com, CrowdStrike, and Monday.com. Over here, remember the 2 parts of that free cash flow equation. Last 12 months, or the rule of 40 equation, last 12 months revenue growth is one part of it, and then free cash flow margin. And so that gets us to the rule of 30. Well, the ones I have underlined, Snowflake, for the last 12 months had a rule of 40 of 114%. That came from 106% revenue growth and 8% free cash flow margin. Incredible that they're growing revenue 106% and their free cash flow positive. Datadog, 70% last 12 months revenue growth, 27% free cash flow margin for a 97% rule of 40. Bill.com, 125%. And this one's a little bit off because there's some acquisitions in here. So that's why, if you noticed, Bill.com was towards the bottom of my position sizes. I still want to see this company work towards being more profitable and then growing without acquisitions. And so I want to make sure it's sustainable. So it's a small position that I'm willing to build over time, but it's got the potential to be a hyper growth company for a long time and get more profitable, which is what we want to see. And we'll have an opportunity to build that position over time. Anyways, 119% rule of 40. CrowdStrike, 66% last 12 months revenue growth, 32% free cash flow margin. So the most efficient in terms of free cash flow margin out of all of these so far is CrowdStrike, 98% rule of 40. And then Monday.com, 91% last 12 months revenue growth, 2% free cash flow margin for a 93% rule of 40. So there we have it. That's the differentiator right there. But we want rule of 40 when you take revenue growth plus free cash flow margin. You want that to be sustainable, right? We want to try to have that for next year as well. The second metric that is super important to me when I invest in software as a service companies, and that really separates these from the rest, is net expansion rate. So what that measures is the amount that current customers spend from one year to the next. So in Snowflake's case, it's at 178%. That means they're getting 78% more revenue in next year than they did from their current customers this year. The reason that's important is because if we're seeing customers spend more, then that's less money they have to spend on marketing to acquire more companies. And it's an indication that they're going to be more profitable and free cash flow generative in the future. So it helps with that second half of the equation. Later on, we know that they can run an efficient company, and at that free cash flow margin, they're likely to be able to sustain that for longer. Datadog, 130%. CrowdStrike, net expansion rate of 124%. Bill.com is NA, and then Monday.com is 120%. So very strong from a net expansion rate perspective for all 5 of these companies. And that's the video for today. Rule of 40, net dollar expansion rate, 2 important metrics when we think about finding the best of the best software as a service companies. I love doing individual reviews of stocks on this channel. So if you've got a stock you want me to review, let me know in the comments below. And each week I'm going to set aside special videos just to review stocks that you ask about in the comments.